All right, welcome to your first real lesson in trading. I want you to forget the news, forget all the hype you see online. Today, we're cutting through all of that noise, and we're going to focus on the core patterns you absolutely 100% have to understand if you want to survive in the S&P 500. This is your foundation. You know, if you're new to this, the market probably feels like total chaos, right? One minute it's up, the next it's down, and you always feel like you're one step behind, getting chopped to pieces. It's frustrating, I get it. And honestly, it's kind of designed to feel that way to shake people like you out. So let's change that whole perspective for you, right now. Okay, so let's dive right in. To really get a handle on the market, you first need to meet its two dominant and, well, very different personalities. The best way to think about them is like siblings. They're always together, but man, they could not act more differently. And here they are. On the one hand, you've got price just slowly, methodically walking up the stairs. It's this long grind that makes you feel safe, kind of lulls you to sleep. But when it decides to sell off, oh, it does not take the stairs back down. Nope. It takes the express elevator straight to the basement. This right here, this is that heart in your throat moment I'm sure you felt, where the price just falls off a cliff. You see these huge red candles just slicing through levels you thought were solid floors of support. Now listen, this isn't some glitch in the matrix. It's a feature, not a bug, of how this market works. So here's where it gets really interesting. For every action, there's pretty much an equal and opposite reaction. A sharp, panicked sell-off like that doesn't just fizzle out. What it actually does is create all this pent-up energy, this fuel, for an equally sharp and violent rally right afterward. And this analogy, you've got to burn this into your brain. The fear and the panic during that elevator drop, that's what's stretching the rubber band. The more panic there is, the more sellers jump in, and the further that band gets pulled back. All of that stored energy is what powers this incredible snapback rally. We call it a short squeeze, where all those sellers are suddenly forced to buy back what they sold, adding even more rocket fuel to the fire. So, the key takeaway here is understanding what actually pulls the trigger, what lets that rubber band go. And you need to know, it is not random. It's a very specific, repeatable move that the big institutions use to their advantage, and your job is to learn how to spot it. This is the trap, right here. See, the big institutions, they need to buy huge amounts. But to do that, they need people to sell to them. So what do? They push the price just below a major low point. This triggers all the stop-loss orders from other traders, and it tricks new sellers into panicking and selling right at the bottom. And then they step in, scoop up everything at a huge discount, and aggressively rip the price higher, trapping all those sellers. So let's look at the basic anatomy of this whole setup, because it has a very distinct shape. First, you'll see a clear low form. Then, price makes the sharp move to break that low. That's the trap. But the second it recovers and gets back above that initial low, boom, the rally is on. It almost always looks like a sharp V or sometimes a W. And here it is in the wild. This is just a perfect example of how that textbook pattern shows up on a real chart. Look closely. You can see this cluster of lows right here, then that sharp flush underneath to grab all the liquidity. See it? And then the powerful recovery that follows. This isn't some rare thing. It happens over and over and over again. So this is the rhythm you need to learn. The elevator down creates the fear, the failed breakdown access the trap and the trigger, and that short squeeze is the explosive result. Now, your job is not to predict the cycle. Your job is to recognize it as it's happening and then execute with discipline. Okay, so now that you know how to spot this powerful pattern, let's get to the most important part. Because look, knowing the pattern is totally useless if you don't know how to trade it. A good entry is completely worthless without a great exit strategy. I want you to look at this number, 90%. This number is your new reality check. I mean it, burn it into your brain. 90% of the time, the market does not just trend smoothly in one direction all day long. It chops, it reverses, and it sets traps. So what does that 90% number really mean for you? It means that if you're constantly swinging for the fences, trying to hit a home run on every single trade, you are mathematically guaranteed to get frustrated and just give all your profits back. We need a better way, a systematic way. And this is it. It's called the level-to-level method. Let me break it down. Step 1, you enter your trade based on your plan. Easy enough. Step 2, you take most of your profit, say 75%, at the very next key resistance level. Why? Because we know the market is choppy 90% of the time. You've got to lock in those gains. Step 3, and you do this immediately, You move your stop loss to your entry price. This makes the rest of the trade totally risk-free. And then step 4, you can let that small remaining piece, your runner, work for you, completely stress-free. This is how you build consistency. All right, let's tie this all together with the final and maybe most important piece of the puzzle, the professional mindset. Because listen, the best system in the world won't make you a dime if your head isn't on straight. So what really separates the pros from the 90% of people who fail at this? Is it some magic indicator, some secret strategy? No, it's not. It is quite simply a lack of patience. You have got to fight that impulse to always be in a trade. This is not a job where you get paid for being busy. In fact, it's the total opposite. Your job is to wait patiently for your pre-planned A-plus setup to show up and to literally sit on your hands and ignore everything else. These right here, these are your true enemies in the market. Just think about it for a second. Have you ever chased a trade because you had FOMO? Or maybe held on way too long because of greed? Or, the worst one, tried to win back a loss with a reckless revenge trade? These feelings, these emotions, they are the barrier to profitability. Your entire system has to be built to defeat them. And I want to leave you with this, because true, consistent success in trading isn't defined by that one big home run you hit. No, it's built on the foundation of the dozens and dozens of mediocre trades you had the discipline to sit out and avoid. So, the next time you pull up your charts, just ask yourself this: am I trading just to be busy, or am I patiently waiting for my moment to strike?